For the past 50 years, China has transformed remarkably, evolving from a poor and isolated country to a major player in the global economy. This change began in 1978 when China started engaging more with the rest of the world. Since then, its economy has grown at an impressive average rate of 9.32% annually for over 4 decades, making it the world's second largest economy. In terms of buying power, China even overtook the United States. China demonstrated its economic resilience by avoiding recession during the 2008 global financial crisis and the COVID-19 pandemic from 2020 to 2021. Yet despite this success, China's economic growth has started to slow down since it overtook Japan as the world's second largest economy in 2010. In 2022, the growth rate dipped to 2.99%, which is a low for Chinese standards. This slowdown raises questions about the future of China's economy and its impact on the region and the world. After the turmoil following Mao's death ended, the ruling Chinese Communist Party struck an unspoken deal with the people. It would continue its strict control, but in return, citizens would enjoy security and rapid economic growth. This approach has largely worked, with China becoming a vital hub in the global supply chain, not just for basic foods, but also for critical resources. For example, China plays a dominant role in the production and processing of rare earth elements essential for today's digital devices, controlling a significant portion of the market. From 1978 to 2022, China's GDP per capita skyrocketed from $156.4 to $12,720, marking a period of rapid economic expansion. Yet this growth wasn't without its downsides, as now some significant challenges are emerging, particularly in demographics. China, once the world's most populous nation, reached its population peak around 2020 and has since begun a gradual decline. It's estimated that India overtook China as the most populous country in April 2023. By the end of this century, it's projected that China's population will drop to around 776 million, significantly lower than its current numbers. This decline poses a real challenge for China's economy, but there are more concerning trends beneath these numbers. The number of working-age people in China has decreased from about 763.5 million in 2014 to 733.5 million in 2022. The World Bank has warned that China's working-age population could reduce by over 10% by 2040. Concurrently, the elder population is rapidly increasing. In 2015, there were 136.9 million people over 65 in China, exceeding the entire population of Japan. By 2030, this number is expected to rise to 238.8 million, surpassing the combined populations of Japan and Egypt, and by 2050, it could reach nearly 350 million, equal to the combined populations of Japan, Egypt, Australia, and Germany. This demographic shift is creating a scenario where fewer young people will have to support an increasingly aging population. This challenge stems from the one-child policy enforced from 1979 to 2015 to control overpopulation. Though the policy shifted to allow 2 children in 2015 and was completely eliminated in 2021, its effects will linger for years, impacting China's socio-economic landscape. For almost 4 decades, China's one-child policy significantly restricted the growth of its younger population. Now, despite efforts to boost birth rates, China faces a critical challenge due to a shortage of women of childbearing age. This situation is partly a result of long-standing cultural preferences for sons over daughters, which, combined with the one-child rule, led to a higher incidence of female fetus abortions and, in some cases, infanticide and abandonment of baby girls. A study from 2015 discovered that in some regions, up to 10% of baby girls were abandoned in the 1990s, while some of these girls were adopted internationally, others faced various hardships or did not survive. Another study estimated that China is missing 62 million women who would have been alive if not for the one-child policy and the bias toward male children. This gender imbalance has resulted in approximately 30 million more men than women in China as of 2021, making it difficult for men to find partners. China's birth rate has dropped to a record low of 1.23 children per woman. And despite the relaxation of the one-child policy, the trend hasn't reversed. High child-rearing costs and restrictive measures during the COVID-19 pandemic have further discouraged childbirth. As India's population continues to grow and remains comparatively younger than China's, businesses might find India a more appealing destination for investment due to its increasing workforce. On the other hand, China's stringent measures during the COVID-19 pandemic, including the zero COVID-19 policy with extended lockdowns, not only affected expectant mothers but also disrupted its supply chains. This disruption has encouraged international investors to consider other locations for their manufacturing operations. Additionally, China faces the challenge of an aging population earlier in its developmental phase compared to Japan or European countries. This demographic shift requires China to rethink its elderly care strategies, which is costly and demands significant changes in policies and institutions. Traditionally, young family members cared for the elderly in China, but with fewer young people, this cultural norm is under pressure. The increasing burden of elder care might further dissuade young Chinese from starting families, exacerbating the demographic challenges. Looking at its neighbor, Japan, China might find some insights into managing an aging population. However, China's economic concerns extend beyond its demographic issues. The Belt and Road Initiative, BRI, launched in 2013 to extend China's influence through infrastructure investments across Eurasia and Africa, has not lived up to its grand expectations and is becoming a trillion-dollar failure. Intended to shift global trade dynamics in China's favor, the BRI is struggling with numerous challenges, undermining its goal to establish Beijing as a pivotal economic hub. The results have been underwhelming. For instance, Kenya's railway project failed to deliver as expected, and Sri Lanka's Hambantota port became a financial burden. The China-Pakistan Economic Corridor, CPEC, initially valued at $62 billion, faces issues like corruption, financial setbacks, and security concerns. Its key project, the Gwadar port, didn't generate the anticipated financial returns, contributing to Pakistan's increased national debt and leading to a $6.3 billion IMF bailout. China's BRI financing practices have been problematic. Unlike Western infrastructure investments, which often feature low interest rates over extended periods, BRI loans can have high rates and stringent terms. China can demand early repayment and restrict borrowers from refinancing. These harsh terms have had repercussions. For example, Italy and the Philippines withdrew from the BRI in 2023 due to unmet project expectations. With more countries reevaluating their participation, China faces challenges in recovering its loans. The financial strain is evident. In 2010, only 5% of China's overseas lending was to financially distressed parties. By 2023, this figure rose to 60%. China has had to issue $240 billion in emergency loans to 22 countries, mostly between 2016 and 2021, often with interest rates double those of the IMF. This situation poses significant questions about the BRI's sustainability and China's ability to recoup its investments. China's diplomatic approach in its handling of the COVID-19 crisis have intensified global skepticism towards the BRI. The United States has compounded these challenges by imposing sanctions on Chinese state-owned enterprises, many of which are integral to the BRI, causing potential third-party partners to think twice before collaborating. Despite efforts to engage with countries like France, Italy, and Singapore to share the financial burden of the BRI, U.S. sanctions have made these partners cautious, leaving China to face the financial risks alone. Domestically, China's rapid expansion has led to a surge in lending, not just internationally through the BRI, but also within its own borders, causing internal economic strain. Municipal debt is a growing concern, exemplified by Wuhan's financial difficulties. The city, known as the starting point of the coronavirus outbreak, has had to demand repayment from hundreds of local entities, including businesses, government departments, and think tanks, which owe a total of around $14 million. This internal financial stress, combined with the BRI's challenges, is adding to the economic pressures facing China. China's stringent zero-COVID policy has significantly strained the finances of its municipal and provincial governments, exacerbating their debt issues. With the economy hampered by lockdowns, these local governments had to funnel substantial resources into mass testing and quarantine facilities. For example, Guangdong province alone spent $22 billion on implementing the zero-COVID measures, while its revenue plummeted. To alleviate the economic impact on businesses, the government offered over $524 billion in tax breaks, further reducing the income of local governments and curtailing their ability to provide services. As a result, some regions have had to cut spending on essential services like healthcare for the elderly, public transportation, and fuel subsidies. Even employees in affluent provinces faced wage reductions, with some experiencing pay cuts of up to 30%. Between 2016 and 2023, China's government debt surged from 47% of its GDP to 102%, a stark contrast to the United States, where the debt-to-GDP ratio is 122%. However, China's debt has been increasing at a more rapid pace. Adding to the financial strain is the downturn in the real estate sector, which is crucial for local government revenue, accounting for up to 40% of their income. The real estate market has seen a significant slump, with land sales dropping 26% from 2021 to 2022, and the top 100 property developers reporting a 33% decrease in new home sales in July 2023 compared to the previous year. Country Garden, a leading real estate firm, faced severe financial distress, abandoning a plan to raise $300 million through new shares amidst declining home sales. By October 2023, there were reports of the company defaulting on foreign debt, with international bondholders seeking urgent discussions. This situation with Country Gardens is indicative of broader challenges within China's real estate industry, impacting the overall economic stability of the country. In 2021, China's real estate sector faced significant turmoil, highlighted by major defaults from leading property developers. Evergrande, one of the giants in the industry, defaulted in December 2021, failing to meet $82.5 billion in interest payments, leading to bankruptcy proceedings. Alongside Evergrande, Kaiser, another key player, encountered severe financial difficulties, resulting in a trading halt of its shares in the Hong Kong Stock Exchange due to doubts about meeting a $400 million debt obligation. The real estate market has been a cornerstone of China's economic growth, contributing up to 30% of its GDP. However, the rampant expansion in this sector raised alarms about a potential bubble, especially given the prominence of China's ghost cities. These cities, numbering around 50, were developed to distribute economic growth beyond the coastal megacities and provide new living spaces for rural populations. Yet many have failed to attract residents or deliver on investment returns, with estimates suggesting up to 50 million vacant apartments. While there have been successes in urban development, like Shanghai's Pudong district, which transformed from a swamp into a bustling area with 5.6 million people, replicating this success in more remote ghost cities remains uncertain. The success factors for such developments include job availability and transportation links, which are not as readily present in these strategically located cities. China's economy is experiencing decreased productivity, partly due to its growing politicization, the increasing presence of Communist Party members within private companies, and the government's preference for state-owned enterprises has caused domestic and foreign investors to become wary of investing in China. This shift could challenge China's position in global supply chains and impact its economic growth. While China has been a dominant force in the global economy, some of its strategies may have been short-sighted. Investor apprehension, U.S. sanctions, and a declining population to consume goods and invest in real estate are factors that could further slow China's economic growth. The country's complex debt situation, both domestically and internationally, raises concerns about a potential financial crisis. China's economic difficulties might also have implications for regional security in the Indo-Pacific. As China's economic growth slows, there is speculation that Beijing might feel pressured to assert its military power while it still has significant economic momentum. This has led to concerns among American military and national security experts about potential aggressive actions, such as a move against Taiwan, especially as some draw parallels with Germany's situation before World War I. The challenges facing China's economy in the coming years are manifold, including managing its debt, transitioning to a more sustainable growth model, and navigating the complexities of international trade and politics. How China addresses these challenges will have significant implications not only for its own future but also for the regional and global economic landscape. What are your thoughts on the potential economic and security implications of China's current trajectory? Do you see its economic issues influencing short-term security dynamics in the Indo-Pacific region? Share your thoughts in the comments and don't forget to like and subscribe for more discussions.